presenting it kind of in another way than your textbook. Maybe give you a little bit more insight into unemployment tax. This one, the history of the unemployment tax as well. If you're into history, you want to know, this one isn't too terribly long. Give you a little bit more detail. I actually don't want to do that. I'm going to do this. So this is the last chapter where we're going to actually talk about taxes, the payroll taxes that we mainly work with in this field. The last chapter, we're going to incorporate everything that we've learn how to then enter all that information into the accounting system and how all of that works. Okay, so those of you who have had accounting, financial accounting, or who are currently taking it, that last chapter should be not too terribly challenging for you. If you've never had accounting though, and you're not currently taking financial accounting, just kind of be forewarned that it may present some challenges because you're going to be learning accounting at the same time. And I am not a financial accountant. I am a tax accountant, so I'm not the best person to teach it. But I can do the journal entries. And of course, I'm here to help you if you have any other questions as we go. But that said, that's for next chapter. Okay, so in this chapter, we are looking at the federal unemployment tax, also known as FUTA, and the state unemployment tax, also known as SUTA. So you're going to hear me call them FUTA and SUTA. That's what those acronyms stand for. Now we're going to talk about both of these together because they work together. They work in conjunction with each other. The federal system integrates with the state system and vice versa. So we're going to talk about what the requirements are to be classified as an employee for FUTA tax purposes. Spoiler alert, pretty similar to what they are for Social Security, Medicare tax purposes and federal income tax purposes. Okay, but we will go through that briefly again. Talk a little bit about the Federal Unemployment Tax Act as well. I'll talk briefly about the history of it. We also have to look at what are considered wages. So just like we did with Social Security, Medicare tax, and income tax, who's covered and what wages are covered. It is just wages again. So, I mean, obviously what we're talking about here in this class is all wages, but other types of income are not considered taxable for unemployment tax purposes. We're going to do those computations of federal unemployment tax. This is the part, the credit against the tax. This is the part that causes the most struggle for students, is understanding this credit against the tax. It's really not that hard once you get it, but the terminology, the wording on it is it seems a little bit backwards when we talk about it, but just to kind of give you a heads up that may be the part that in the chapter that conceptually is a little bit the most difficult to understand. And that credit reduction. Experience rating system. This is a system that is used, well, when we get to it, we'll talk more about how the taxes are collected, and then also a little bit on how they're dispersed and how those some of these tax rates are determined. Because at the federal level, the tax rate is constant. Everybody has, well, if you don't have any credit reduction, everybody has the same tax rate. Certain employers may have what's called a credit reduction. For state unemployment taxes though, not every employer has the same tax rate. It's insurance. Unemployment even though we call it taxes, it is an insurance policy for those employees who become unemployed. It's to provide payments to them if they become unemployed. So it is a type of insurance. And just like insurance, we know that the more you use it, the higher your rates are for insurance, right? So when you're driving, if you get into a lot of accidents, if you get a lot of speeding tickets, you're a higher risk. The insurance company is going to have to pay out more. Chances are they're going to have to pay out more in claims if you are a more reckless driver, and eventually they just may not insure you at all. So the same sort of thing applies with federal unemployment. Although they don't get to the point where they won't insure you, but your rates can be extremely high. It's based on, those rates are going to be based on your utilization as well as the industry that you happen to be working in, because certain industries are more prone to higher levels of unemployment than other industries are. So this is the experience rating system that we're gonna take a look at to determine how those calculations are done. Now, it's not, each state is going to do it a little bit differently. And you'll see in your book there's a table, and I'll go through it when we get to that point, but there's a table in there that shows the minimum and maximum rates for each state, as well as a description of the benefits that the states provide. Again, we've got more reports that have to be filed. So remember we talked about the 941, which is done on a quarterly basis and reports the Social Security, Medicare taxes, and federal income taxes that have been withheld. Now we're going to talk about what's called the Form 940, which reports all of the federal unemployment taxes that are due. This is an annual report, so it's not quarterly, it's annual, but just like with the 941, the deposits of the tax may be due at a different time from when the actual report is due. So we've got a schedule, we got to look at what the schedules are there. And we'll take a look, I'll see if I'll try and pull up the Iowa form that employers fill out to report their state unemployment tax and to calculate their state unemployment tax. Sometimes it's a little bit difficult to locate online. They kind of hide it a bit. But I will try and pull that up at the end as well, so you can get a sample of what that report looks like. Okay, understanding that each state is going to do it a little bit differently. So FUTA and SUTA. FUTA. So it was passed originally in it says 1935. I think there was another part to it in 1939, which is what the website said. Again, Great Depression, right? We were experiencing very high levels of unemployment, and there really was no social safety net to protect individuals once they became unemployed. So we decided as a society that we didn't want our citizens to suffer through that. So we passed these series of social insurance types of laws. So we had Social Security that was instituted, Medicare that came a little bit later in the 60s, but we also this federal unemployment tax system. So, and what it does is if an individual becomes unemployed and they meet the qualifications, they can receive weekly benefits from this unemployment system. Now, they don't last forever. They're for limited periods of time, and actually, during COVID, there were a lot of changes to the system, but we have reverted back to the system that we had in place before COVID. So during COVID, as you probably all recall, there was very high unemployment, especially in certain industries, and they increased the rates, the benefits for individuals who are claiming those rates. But again, we have reverted back to the pre-COVID regime for unemployment taxes. This is a law that imposes taxes only on the employer. So federal unemployment taxes, the employee never pays them, at least directly. Now, they probably pay them in the form of reduced wages, but there is nothing that is withheld from an employee's paycheck for federal unemployment taxes. State unemployment taxes. So, as I mentioned here, so each state has a trust fund, and into that trust fund go the collections from each employer. You'll see that when we get into the nitty-gritty of calculating these, the federal unemployment tax rate is much lower than the state unemployment tax rate. The reason for that is the federal unemployment tax actually only administers the program. So they provide oversight for the program. They also give approval for state programs. So each state has to have their program approved by the federal government. The states are the ones that actually pay the benefits. So, and that is reflected in the tax rates that are paid. So every state has their own unemployment tax system that is put in place. And again, for the most part, employers are the only ones that pay state unemployment taxes. But as you saw in some of those, I don't know if you noticed on the W-2 that we just went through, it was a Pennsylvania W-2. It talked about state unemployment insurance that was paid by the employees. So there are certain states where employees may pay some of those, some amount toward the unemployment tax system within that state. Iowa is not one of those states. So employees do not have to contribute anything in Iowa. Okay, so which employers have to pay tax? So again, it's the same, kind of the same criteria as with Social Security, Medicare taxes, and with federal income taxes with regard to who's an employee and who is an employer. Under FUTA, if the employer pays wages of $1,500 or more during any calendar quarter in the current or preceding calendar year, so that would be total wages for all employees, or they employ one or more persons on at least some portion of the day in each of 20 or more calendar weeks during the current or preceding taxable year. So that's a little convoluted there, but just the 1,500 or more shows that the vast majority of employers would be subject to paying this tax. So a couple of things that they mentioned here. What is a calendar week? 7 successive days beginning with Sunday. Okay, so Sunday through Saturday. 20 weeks do not have to be consecutive, so they could be scattered throughout the year. And the employees that are counted don't have to be the same employees. They can be different employees. Part-time workers are considered to be employees. So just because you're part-time doesn't mean that you're not covered. You're not a covered employee for purposes of FUTA, or a covered employer as well that has part-time employees. Employees would include any individuals that are on vacation or sick leave. Members of a partnership. So I had mentioned to you before that partnerships are a little bit different kind of entity. Partners in a partnership aren't considered to be employees of the partnership. Even if they provide services to the partnership, they're considered sort of to be self-employed. So members of a partnership for FUTA purposes as well would not be considered to be employees. So no FUTA tax is paid on their behalf, those partnerships. And again, agricultural and household employees and employers have some special rules regarding FUTA tax, which we won't go quite into here. All right, so we kind of go back to this whole who has control. If an employee is considered to be an employee for Social Security and Medicare tax purposes, 99% of the time they're going to be considered to be an employee for FUTA tax purposes as well. So if the employer has the right to direct and control the employee's activities, specifically included, we've talked about these before, agent drivers, commission drivers who distribute food or beverage, traveling or city salespeople as well. So these would be people who are working mainly outside of the office. There are some specific exceptions. Casual laborers, so individuals who are just hired as day laborers would not be covered under FUTA. Again, partners, directors in a corporation as well would not be considered to be employees for FUTA tax purposes. And foreign students and exchange visitors, if they are earning wages, would also be excluded from federal unemployment tax. Questions so far? So generally the same rules apply for SUTA, okay, as far as who is an employer and who is an employee. Employees are generally covered under SUTA if they are covered under FUTA. It mentions here there are some variations in specific state laws. I can't name any of those off the top of my head. So there is this ABC test. I think your book goes into a little bit more detail on it. To determine exclusion from SUTA coverage. All of these have to be met in order for an individual, a worker, not to be covered for SUTA tax purposes. So they have to be free from control or direction. So we go back to that whole control, that control factor. The duties that they have to be performed outside the usual course of business. So whatever their usual course of business is, some sort of duty that isn't related to that. And I'll give you an example in just a second. And they're customarily engaged in independent trade or business. So let's say that you are you're a bookkeeper at a CPA firm. And you also happen to have a side business where you clean offices. Your side business is your business. You provide that service for multiple different businesses, but as a bookkeeper, you only provide that service for this one business, so you're an employee of that business. You go in 9 to 5, you have a boss, they tell you what to do, how to do it, they give you the training, all of that stuff. You meet all that criteria for being considered an employee as a bookkeeper. Well, the employer needs someone to clean their office as well. So you provide the service of cleaning that office after hours. But you have a business that does this. So you're providing that, again, you're providing that service to multiple businesses. As an employee, you will be covered under FUTA and SUTA by that employer. But when you are engaged in the cleaning activities, that's outside of the usual course of business, right? And you are engaged in an independent trader business, and you can go in and do it how you want to do it. It's your business. You provide all of the supplies. You choose how you're going to perform that duty. In that case, as an office cleaner, then you are not covered under FUTA or SUTA for that employer. So any payments that they make to you as a contractor would then not be included in the calculation of FUTA or SUTA. Does that make sense? Kind of to divide that up between those different types of duties. So even though you're providing a service to the same company, because the nature of the services are different and how they're performed is different, not all of the payments that they make to you would be considered covered under FUTA or SUTA, because you're not an employee for all of it. Part of it, you're an independent contractor. Okay? All right. So we've got a lot of employees that work in multiple states, right? Like I said, there are different state laws. And in fact, I'll pull up, it's probably a good time to pull this up. Just to kind of show you the differences between the states. kind of hard to see here because it's squished over to the side. But for example, well, let's look at Iowa, shall we? Here's Iowa. So Iowa, the tax rates for Iowa range from 0%, so you might have a 0, that's the best tax rate there is, right? 0% up to 7.5%. On the first $34,800 of wages paid to each individual employee. It's done on an individual employee basis. There's no waiting period. These are the maximum, these are the benefits. Maximum benefits per week in Iowa, 531, minimum 79, for a maximum period of 26 weeks, so half a year, 6 months out of the year. After that point, you don't receive benefits. You don't receive benefits any longer. So if we look though, if we look at, so that's Iowa, then we've got Illinois. So there are a lot of people that maybe live in Iowa, work in Illinois, or vice versa, over in the Quad Cities area or Dubuque, that sort of thing. You're right on the line. Illinois has different tax rates. So they range from 0.725% up to 7.65%, and theirs is on the first $12,960 of income. So Iowa, the income goes up to $34,800. For Illinois, it only goes up to $12,960. The benefits are different too. Maximum so if you look, where's Illinois? There we go. They're blue. Maximum benefits in Illinois are $449. Iowa's actually more generous. But if you notice, they also collect more in taxes because it is applied to a greater amount of income in Iowa. Maximum duration is 25 weeks in Illinois. Why 25? Minimum amount, $51. So you've got these multiple states that have different rules. Now remember, all of them have been approved by the federal government, so you know the federal government has signed off on them, so either one of them is fine for individuals in that state. Well, what if you work in multiple states? Or you live in one state but you work in another state? Whose rules do you abide by? So there are 4 different factors that have to be considered, and they are in order here. If an employee, well, first off, if you live in one state and you work entirely in another, so you live in Dubuque and you work in Galena, Illinois is, because all of your work is performed in Illinois, that's where you are going to be covered by unemployment tax because that's where your employer is. But if you have, say you have an office in Dubuque and you also have an office in Galena and you work part-time in one, part-time in the other, then we have to go through and place and decide in order each of these factors to determine which state you're going to be covered under for unemployment taxes. So first one is the place where the work is localized. So if you happen to spend more of your time in one or the other, then that's the state that you're going to be covered under. If you can't determine that, maybe it's equal, then the location of the base of operations for the company. Well, maybe you can't determine that either. The location of the place from which operations are directed or controlled, so where your boss is, where your supervisor is, where the control is coming from. If all of that fails and you cannot determine it, then it comes down to the location of the employee's residence. So only at that point would it be wherever it is that you live. That would be the state where you have your coverage for unemployment tax. So there is an example over here. Let's see. I wanted to look at it. Let's take a look at this example here while we're thinking about this. So again, let me write these down, kind of summarize them. so work is localized. Second, location, base of operations. Place from which operations are directed. And number 4, the location of the employee, residence of the employee. Okay. So, and again, that's in order. So, let's take a look at George. George is a resident of Arizona. All right. Okay, Arizona. He works as a marketing executive in a cell phone manufacturing company. His job requires him to travel and perform services in Illinois, Michigan, Arizona, and Ohio. Got 4 states here. His work is equally divided amongst the 4 states. All right, so we can't really determine where it's localized. It's equally divided there. He receives instructions as well from all of the 4 locations. Maybe he's got a boss in each of those places. And the business records are maintained in Ohio and Michigan. All right, so we've got no place for where it's localized. We've got no base of operations because it's divided equally, directed from Michigan and Ohio, from 2 states. So we can't really determine this either. George is covered under which of the following states as per the rules laid out for interstate employees? We'd be left with Arizona, right? So, even though that's because, and we're left with number 4, wherever it is that he lives. Okay, so just kind of an example of how that all works when you've got some, when you're not quite sure which state the individual works under. All right. I think we're going to end there because I'll start with this on Tuesday, those reciprocal arrangements. So get your homework done tonight and get it in. It is due by midnight tonight. And over the weekend, if you can get started reading chapter 5, that would be great as well. Any questions?